Hey guys, welcome back. In today's video, we are talking about forcing hedge funds to buy, how we are making history, the bullish weeks, and many more in this video. First, we're taking a look at this. Yesterday's video, we talked about the shares that were owned by Pentwater. Now, they were received as consent fees that were paid in common stocks instead of cash. So this was the reason why we saw that they had these shares of AMC. And now the reason why I firstly think this is good is because of two reasons. The first reason, which we talked about and we'll go on about it later on as well, is of course the fact with the history of Pentwater and how they previously orchestrated the car squeeze and what they could do for AMC. But secondly, and this is something we talked about in the past before, which is when firms, especially the firms who are lending out money towards AMC, are willing to take shares instead of cash, I personally think that is an extremely good sign already. It means that they think there is more value by getting the shares than there is cash because they realize what the return on those shares can be and will be in the future. And so with this, we obviously understand how firms are now seeing how valuable AMC shares are and of course willing to trade for it. Now, the second thing or rather the first thing what we talked about was of course orchestrating the previous squeeze. You can see, is Pentwater running its car playbook on AMC? They took a big 15% equity stake at near lows with a high short interest of 17% and supply locked by big holders. Will they buy deep in the money puts like they did in car to force the market maker to delta hedge? We saw car jump 700% of this. Can AMC be next? So we talked about in terms of the position that AMC and car is in is of course very similar. We were both experiencing the volatility back in 2021 and where we saw that shorts claimed to have covered, but they didn't. And that's how the car squeeze was able to happen. Now with AMC, it's an even bigger situation. There are more synthetics, there are more naked shorts to obviously be covered, meaning when it's short squeeze, there is going to be a bigger percentage jump. Now, with this, what we can see is potentially Pentwater trying to orchestrate another squeeze. Now, one of the things that we are talking about here is the short interest. Now, firstly, here it says 17% and it's high short interest, which actually under normal circumstances, it already is high short interest. But we have to remember for AMC is of course much higher than this. It's in the hundreds, the thousands of percentage, which we've seen from other indicators. But another big thing about this is one of the reasons earlier why I said we are in the same situation is not only because of the synthetic shorts, because of the fact of what happened back in 21, but rather because car before leading up to its squeeze also saw a 17% similar around that level short percent interest, along with the fact they had $25 billion of debt. And so if people are claiming firstly that AMC has a debt problem, so it can't squeeze, well, firstly, take a look at car. Secondly, if they talk about how a 17% isn't a high short interest, once again, take a look at the short interest of car before it squeezed. And this is why I said we are in a very, very similar situation. We can also see as we saw the price increase from 0.98 to 1.67, we were also seeing the net increase in reported short interest. So this is another reason to understand why the 17% that we're looking at, once again, being self-reported, is of course much lower than what it should actually be. And what we can be seeing is how easily these shorts will be forced to be liquidated and have to cover their shares when the time comes. And so what we can see here it's just so many of the same factors that are linking up together. And it's why I firmly believe is that we can easily orchestrate a short squeeze if everyone works together. And especially when we've had a company that holds shares of AMC that has recently done this, it seemingly look like it's even more possible. But of course, that requires for everyone to come into unison. That is the difficult part. But nevertheless, is to talk about the situation that we are in right now. And amidst all of this, we're seeing FUD on AMC. Now, it's no surprise. AMC is obviously providing to be a threat. And this is why people want to then damage AMC. You can see when you understand why people tried so hard to remove CEO Adam from his position, you understand two things. Adam is the only reason AMC never filed for bankruptcy. Anyone else in his position would have. The people who called for his resignation and or removal knew how forward-thinking Adam is, and they wanted him gone before he implemented adding and upgrading premium screens across the theater chain, diminishing the prospect of AMC taking advantage of what Adam knew 2026 would bring. One of the biggest reasons for why AMC is in the spotlight right now, why everyone is in need of AMC, is because we took the first mover advantage within the industry right now as we see the box office recover and improve and boom more than what we could expect. AMC is at the forefront because they were already thinking of how to grab the audiences when we see the box office do well. And that's why we're in that spotlight. And at the end of the day, you got to know what you hold. You're not threatened by others' opinion on AMC, but rather you find it hilarious how stupid they sound. Because when we go back to what we've said here, the 2 points here will prove exactly why this is important. Firstly, I hope people understand that Cineworld/Regal bankruptcy wiped out all shareholders' value. Hedge funds took the company over, same could have happened to AMC, but didn't, thanks to retail investors and a strategic board. AMC Theatres is still operating and doing so with a much stronger balance sheet. And that should already sum it up. People are upset about the fact that AMC diluted, which I can understand the point in terms of you're seeing your shares get diluted. It's something that you obviously wouldn't want to see. However, people fail to realize is that had we not done this, you would have seen your share price go to zero. You would have seen bankruptcy. To that point, then you wouldn't even have shares of AMC. And I think that should be one of the biggest takeaway that we get here. Yes, there are of course other things that AMC can do that will bring AMC to a whole new level. We talked about strategic partnerships, we talked about other various investments, but it isn't to say that AMC isn't improving. And the very fact we're not seeing AMC bankrupt, we're still seeing shorts trying to suppress AMC, meaning that firstly, there is still fundamental value in the future, and secondly, that the short squeeze is still alive. That itself should already be important enough. So that's talking about point one. We are not bankrupt. Then what we have to see is, you can see Adam Aaron talk about this, a clear through line in the successful box office opening we've seen so far in 2026 is that filmmakers are delivering what audiences want. Movies that entertain, amuse, and delight. The success of Michael once again showcases that movies are meant to be experienced in theaters with their giant screens and soaring sound systems. So as we're seeing how movie makers are now delivering exactly what the audiences want, we then have to fill the second part, is delivering where the audience want to watch it. And that's exactly what we're doing. We have the things that attract the audiences now. We have the good movies. And so we have to deliver the best location. And that's exactly what AMC is doing. If you want to take a look at some of the movies that we are seeing, if you want to see some of the data, you can see, firstly, last Friday, we saw how well AMC was doing. We saw how well the box office was doing, especially with the release of Michael. And you can already see Michael just made history. We had the 88 million plus opening weekend, biggest biopic debut ever, surpassing Oppenheimer, highest opening day of 2026. That is the first thing. And that already shows you what real demand looks like. And remember, people are going to AMC to watch the movies that are doing extremely well. Not only that, Michael is taking the European box office by storm, soaring the biggest opening weekend of all time for a music biopic in multiple European markets, including France, UK, Germany, Italy, and Spain. Now, the reason why this is important is that Odeon Cinema is a large European cinema chain, which is part of Odeon Cinema Group / AMC Theatres. With that, UK, the largest single market for the Odeon brand. So now we're seeing in Ireland, it makes Odeon one of the Europe biggest operators. In Germany, Odeon's strong regional. Italy, one of the top chains. In Spain, Odeon's the market leader. Going back to what we talked about here in terms of the countries that Michael's doing well. AMC is benefiting from this as well. Now, of course, AMC has put a lot of their focus towards in the US, and of course they should, but they definitely haven't neglected all the other regions. We've recently seen, or rather in the past, we've seen their kind of going into the Middle East. We know they're still focusing on European markets, and you can see exactly how well this is doing. On top of this, we're seeing other movies that have great margins that are doing well. Project Hail Mary, which crossed the 600 million mark at the worldwide box office, and it only cost 190 million to produce. And I think one of the biggest point about this is that now movie makers makers are seeing the opportunities. They're seeing the profit margins that could be made, and that could incentivize even more movies to be released. And that's exactly what we want to see. We want more movies, of course, maintaining their quality, if not getting even better, but also seeing the quantity to increase along with that as well. And that will truly be the boom of the box office. And amidst all of this, you can see Wall Street's attempt to drive down the price of AMC are laughable. Do they honestly think we don't see the packed theaters and armfuls of merch throughout 2026 and beyond? And so as we're seeing the price being suppressed on AMC, we know that it isn't because people are selling. Because why would you hold years of AMC and now you're finally seeing how well they're doing fundamentally and suddenly decide, oh, let me sell? Obviously, that isn't a thought process. The reason why we're seeing the price declining isn't because people are selling, but rather because the shorts are suppressing. And we know that from the start, but what we understand now is that the more they suppress it, the more in terms of a disparity there will be, and that will actually attract even more people to buy AMC. And you can see AMC, the largest theater chain on earth, 1.64 per share. Cinemark, not the largest theater chain, at $28.99 per share. Analyze that for a minute so you can realize what a discount these frauds have been giving us for a very long time now. Now, one of the things we talked about is, of course, you can't just look at a share by its price. What we have to understand is that obviously there is market cap involved. And I understand people may not like this thing, but I do agree that you can already compare it. At 164 and 28.99, when you compare the market cap, AMC is extremely discounted. I've already talked about how the fair price of AMC should already be in the high double digits, if not the triple digits, when we take a look at the future prospect, when we take a look at the earnings, when we take a look at the fundamentals, when we take a look at the potential there is. But when you already take a look at the face front value of between Cinemark and between AMC, you already know we're undervalued. And that's why people are now shifting their focus from Cinemark to AMC. But one of the biggest reasons for why we're seeing the disparity happen in the first place is because of this. AMC is owned mostly by retails, roughly 65% in the hands of everyday apes, compared to Cinemark, 100% plus institutional, and IMAX, 93% plus institutional. Most big companies are 70 to 90% owned by Wall Street. Hedge funds will love to see AMC fail and go bankrupt, so they never have to return all those borrowed shares. So one of the things we have to realize, and again, is why we talk about this disparity between Cinemark and AMC, is because AMC is a retail stock, but IMAX and Cinemark are, of course, institutional. Now, even then, we obviously see more than 65%. But when you include all the synthetics that have been bought up to the institutions by the institutions as well, it may take the retail ownership to 65%. But if we're talking about the real shares, the original, the very, very float that was beginning of AMC, those are owned by the retail. And that's why we know that these market makers don't want to see AMC succeed and they want to push AMC down. You can see they told you theaters were dead, but 4 million at AMC in 5 days, 217 million global opening, packed theaters worldwide. This is the AMC comeback that they didn't plan for. And this is how we're seeing AMC thriving and succeeding. We can see 4 million people watched the movie at AMC theaters last weekend. At 1.6, this stock is criminally undervalued. Incredible potential as a long-term deep value company and massive squeeze potential. This is why I talked about how more and more people are attracted to AMC and why there's a big incentive for money to be flowing into AMC right now. And if we take a look at the technical, you have no idea where you are at now. A lot of people are getting hyped about the Roaring Kitty return in May, which is possible, but also expecting big gap up. And now we're seeing so much catalyst from AMC right now, which is really showing us that we are going to go towards the next level. And if you want to look at some other technicals, you can see a low volume pullback like this is okay. And the daily print is bullish. Coming into this week, we are seeing bullishness. And yes, we started off the week already with a green, but I'm expecting more big things to come. When you take a look at GameStop, you can see how GameStop is printing new revenue streams while hedge funds short are still wiring cash to media to declare it going to zero. Now they're extremely worried about GME as well right now, especially we're seeing people buy, especially we're seeing Michael Burry being extremely vocal about GME. If you take a look at the fundamentals, GME at 1.24 has a better price to cash ratio than 499 out of the S&P 500 companies, and they are profitable. No wonder Michael Burry bought more shares multiple times. Furthermore, what we can see is how recently we talked about how potentially Trump wants to kind of deal with the naked shorts. And now there's a big reason for why we could see this possibly happening. Firstly, if you take a look at this, illegal short selling undermines innovation-driven growth. The future of Korea's capital market does not hinge on whether to support or oppose short selling. So one of the things we talked about is how firm South Korea is in terms of tackling short selling, and you can see how well it's done for them. If you take a look at this is essentially the equivalent of the S&P, but for South Korea. If you take a look at kind of where this rise happened, you can see how well the chart has moved. Right at the bottom is when they stopped naked short selling, and you can see how that has done for the market when they removed naked short selling. Now, not to make this political, not to make this anything about the presidency, but at a time like this where we're seeing how movements are happening, where we're seeing how certain things needs to be done, a potential change to the stock market, especially to bring value, would definitely be worthwhile. And one of the biggest things to do right now, one of the easiest things to make value for the market would, of course, to be stopping naked short selling. And so that is something that we could possibly be expecting. On top of this, reverse repo, we talked about it last Friday, 0.082. It's very likely that it's going to go to zero very, very soon. And now this is going to be big because of the relationship it potentially has with the GME and AMC toxic swaps. And that we talked about will have to be forced to cover. We're also seeing Bank of Japan expecting to delay rate hike again. Now we talked about how this is actually brutal for the US market and how this could cause an even bigger unwind that would then cause the market to crash. Something we've been talking about for a very long time, but we're still keeping a close eye. We're also looking at this, 3 days until China takes the axe to high frequency trading. And now this is going to be quite detrimental because it's going to take out a lot of firms who are not only based in China, but the main quarters are in the US. So if we're going to be seeing a large amount of their money being cut because they can't high frequency trade, that will be extremely positive for us as we're going to be seeing the collateral stress for these shorts. As always, this is financial advice, and I'll catch you guys next time.